Okay, so exercise 10-1 says Rizio Company purchases a machine for 12,500, terms 210, net 60, FOB shipping point. The seller prepaid the $360 freight charges, adding the amount to the invoice and bringing its total to 12,860. The machine requires special steel mounting and power connections costing $895. Another $475 is paid to assemble the machine and get it into operation. In moving the machine to its steel mounting, $180 in damages occurred. Materials costing $40 are used in adjusting the machine to produce a satisfactory product. The adjustments are normal for this machine and are not the result of the damages. Compute the cost recorded for this machine. Rizio pays for this machine within the cash discount period. Okay, first thing about this problem, because what I have noticed, students will do like, a homework problem in the morning, similar to this, and just got here in the grace of time. What I tell you, 15 minutes? I know it. By Memorial Drive, huh? No, I'm kidding with you, but you did just make the mark of 10, 15, or whatever time it is, yeah, 9 to 10. So what is the one thing that we should not even care about in this problem? What do you think? Should we care about the N60? We could care less when the due date is, right? Because he paid it when? Within the discount period. So we care about the 210, which means 2% as long as it's paid within 10 days. But we don't care about the N60. And we also don't care about FOB shipping point because we know he paid the shipping, right? Okay, so if we have to break this down, because ultimately we need to know the amount of cost. What is the first cost that we are concerned about? Which is what? The price. What is this, 10-1? So price, how much was it?
12,500.
Okay, and what's the next cost that we're concerned about?
The freight charges.
The freight. What should we do before we include freight?
The
Discount. And why do I say that?
because you said it was
Not only that, but what else?
the discount comes directly.
The discount comes directly from the price paid, right?
Yes.
And the discount percent was how much?
20%.
Okay, so did they give you the amount of discount they just gave it to you, right?
Yeah, good.
Oh no, they didn't. They wanted to calculate.
Okay.
Okay, so
2 and 10 to the
2% times the 12,500, which gives us how much of a discount?
$250.
$250. And what is the new amount of this purchase?
12,250.
So 12,250. Now we need to include all those other costs. Starting with what?
The quiet special loan. The power connection.
Yeah, just said it earlier. What's the first cost?
Freight. Oh, the freight.
Freight. Miss Brittany, you following us out there?
Yes.
Okay. Freight, which was how much? 360. What's the next cost?
The mounting charges, the machine requires special steel mount on the power connection.
The mounting, which was how much?
$895.
$895. And what's next?
$475 is paid to assemble the machine and get it to operation.
So assembly, how much is that? $475. And what else? Is there anything else?
What is that? Damage. Only the $40, not
That's
the
it.
180.
So the $40 is for the materials used, right? And why do we not include the 180?
That doesn't stop the thing from working the way it's supposed to.
Right. It's a repair. It's damages that have occurred, right? But that had nothing to do with the purchase. You guys understand that, right? Those damages occurred after purchase. That has nothing to do with the cost. So when we add all of these together, so it's 12,250 plus 360 plus 895 plus 475 plus 40. What do we get? $14,020. Everybody came up with the same amount? Good. Now let's just say that 180 was like a normal cost, like a normal expenditure. Then at that point we could include it. If we could honestly justify, good morning, if we can honestly justify and say that it was a part of getting that asset together for intended use, then we can include it. But because it was not, we won't include it. Good. What's the next one? Exercise 10-3. And at some point, let me know about a break, because otherwise I'll keep going. Okay. Exercise 10-3. Latua Company pays $375,280 for real estate plus $20,100 in closing costs. The real estate consists of land appraised at $157,040, land improvements appraised at $58,890, and a building appraised at $176,670. Allocate the total cost among the three purchased assets and prepare the journal entry to record the purchase. So the first thing we need to do is find out the total cost of the acquisition, right? And how are we going to do that? The appraisal and what else? What else? Closing costs. What was the purchase price? Say it one more time for me.
$375,000.
And what were the closing costs?
$20,100.
So that means we have a total cost or total acquisition of how much? $395,380. Good. Okay, so at this point, they also want us to allocate that total cost against the three assets. The three assets are what? Land. What else do they have? Land improvements and building appraisal. So land improvements. And you said building appraisal? And we're going to allocate based on what? What do they want us to allocate based upon? So you got an appraised value, right?
Mhm.
Didn't they give you appraised value? And then you have, we gotta find out how to apply that 395, 380 according to what has been appraised. So what was appraised for land? 157, 40. And what about land improvements?
58,890.
890. And building.
176,000.
When you add all those together, what do you get?
$392,600.
392, 600. Now, we need to find a percent, what percentage these are allocated, okay? How are you gonna do that? Remember, just going back to math. Take this cost, the single cost, and divide it by the total cost, and what percent do you get? So tell me for each one of these, because ultimately you're trying to reach 100%.
The first one is 0.4%.
So that means what percent? 40%?
Divided. The second one is 15%.
15%?
45%.
And 45%. And do we equal 100%
Yes, ma'am.
down here? All right. So now that you have the percent, what should you do?
Multiply it.
We multiplying each one of these by this, are we not?
Yes.
So that you can find an apportioned cost, is what it's called. So when you do 40% or 0.40 times 395, 380, what do you get?
158,152.
158, 152. 15% or 0.15 times 395, 380. 59,307. 395,380 times 0.45.
177,921.
Okay, and of course you need to add all of those together to get our total apportion cost, because ultimately we should come back out to what?
395, 380.
That's it. And just let me know, I'm gonna write it up here, but let me know that that matches.
Yes, ma'am.
Yes, it does. Okay. 395, 380. And lastly, they're asking us to do journal entries or a journal entry to record this purchase. Okay, good. So now we need to do the journal entries. How are we gonna record this purchase? What do we debit and what do we credit here?
Debit machine.
Land, debit land, land improvements. And what was that third one? Building. And what do we credit? What's the amounts?
Cash would be 395, 380.
Good. Cash is gonna be that $395, which is the total acquisition cost, $395, $380. And what is gonna be land? What's the apportioned cost for land?
$1,580.
Huh?
$8,000. I'm sorry.
What is it? What is it? 152. And land improvement? And building? Good. All right. What's the next problem? 10-6. Am I right? All right, exercise 10-6. Ramirez Company installs a computerized manufacturing machine in its factory at the beginning of the year at cost of $43,500. The machine's useful life is estimated at 10 years or 385,000 units of product with a 5,000 salvage value. During its second year, the machine produces 32,500 units of product. Determine the machine's second year depreciation under the straight line method. Now we know it's easy because all we need to do is figure out what the straight line amount is, right? It's the same every year. That's the reason why we do straight line. So what is the equation for straight line depreciation? Cost minus salvage value divided by useful, we'll just say useful years. In this case, for this problem, what is cost? $43,500. Is there any salvage value? 5,000. And what's the useful years? 10 years, which means we need to have depreciation of what? 3,850 every single year, right? That was an easy one. Next one, exercise 10-7. Refer to the information in 10-6. Determine the machine's second year depreciation using the unit of production method. Now, what were the units of production require 2 steps, does it not? Well, nobody said anything, so I'm assuming no. What's the equation for units of production? What's step 1? Cost minus salvage value. Estimated or of production? What's step 2? Price per unit or per unit times what? Time unit consumption. So going back up here to step 1, what's the cost in this problem?
43,500.
Because they told you to refer to the previous one, right? And the salvage, I remember, was 5,000, right? And how many units produced?
32,500.
Each year from 3,008.
In other words, what's the useful life if we're dealing with units from that previous problem? 385,000 units, right? That's the thing that you have to look at. Don't get the wording confused. This is equivalent to useful years. Okay? So I don't want you to get confused. 385,000. What's this amount for step one per unit?
10%.
10 cents per unit. So now obviously we float this 10 cent down here to step two, right? And we multiply by how many units were consumed?
32,500.
32,500, which gives us a depreciation of how much?
3,250.
3,250. I'm gonna give y'all a moment to write that down since y'all say I moved too fast.
What's the point 10%? That's the cost for the total unit.
Point 10
Break it
cents.
down, yeah.
Uh-huh.
So this is step 2 for the.
Step two is to take your price per unit, which is the 10 cents, and multiply it by the units consumed, which is 32,500 units. Okay, the next exercise is 10-8, which also uses the information from 10-6. It says determine the machine's second year depreciation using the double decline balance method.
You're on 10.8, right?
Uh-huh. 10-8 now. So double declining, that also has two steps. What's the double declining step one? So 100% divided by useful years. And and that's going to give you your single rate, right? Step two, you take your single rate and do what with it? And that's going to give you your double rate. And then after you get the double rate, the third step is for you to do what?
The double rate times the beginning book value.
Double rate times beginning book value. All right, so looking at those same numbers, for step one, 100% divided by how many years? 10 years gives us what rate?
10%.
And then we're going to take this 10% and then do what with it? Multiply by 2, which is going to give us 20%, which is our double rate. And then we're going to take our double rate and multiply that by what? 43,500, which gives us what? 8,700. And we're still not done there because what else do we, because that's the first year, right? 8,700 is the first year depreciation. What about the second year? What do we do to get the second year? You subtract first year depreciation from
The beginning book value.
So beginning book value was 43,500, correct? Subtract 8,700, what do we get? 34,000, you said 800? And then we're gonna take that 34,800 and do what with it? Multiply by a double rate to get the second year depreciation.
This is 69.
6,000.
6,960.
Good. Okay, good. Y'all are pretty smart, I think.
We have to sit there and write this down.
Yeah, I'm not gonna go to the next one. Go ahead. Even though all this will be emailed to you after class, we still got 3 more problems, and after those 3 problems, we'll take a break and then come back in and start on chapter 11. You guys ready?
Yes, ma'am.
Okay. All right, so exercise 10-9. On April 1st, 2012, Cyclone's Backhoe Company purchases a trencher for $280,000. The machine is expected to last 5 years and has a salvage value of $40,000. Compute depreciation expense for both 2012 and 2013, assuming the company uses the straight line method. So, straight line. What's the straight line method? The equation, cost minus salvage value divided by, in this case, what's the cost? 380,000. Is there salvage? 280,000.
40,000.
Okay. 40,000. What's the useful years? What's the amount of depreciation?
It's 280,000.
What's going on with you? Who said 380? Nobody will ever say. 280 minus 40,000 divided by 5 years. What's the depreciation? 48,000 per year, right? Now, ooh, this is wrong. Why is this wrong, Mr. Coleman? When did they purchase it? April 1st. So that would be a partial depreciation, right? And partial in what way? What are we gonna do?
Divide 4, multiply by 4 times 4 over 12.
4 months over 12? Okay, so, no. The 4th month of the year is when they purchased it, but they don't depreciate until the end of the year. So how many months from April to December? 9. They purchased it April 1st. So you gotta count the full month. What,
So you use the rest of the months of the year
right,
versus.
because they purchased it the 4th month, so they could only depreciate from when they purchased it to the end of the year. What's the partial year depreciation for year 1? Even? Okay. What about year 2? Year 2 would just be the normal, right? 48,000. I'll let you write that down before we move on. Everybody has this? Okay, exercise 10-10. It says, refer to the information in exercise 10-9, compute depreciation expense for both 2012 and 2013, assuming the company uses double declining method. So this is the first time you're gonna be doing a problem using double declining, also using partial year depreciation, because it still has to be the same assumption. So if we're gonna do that just for the first year, double declining has 3 steps, right? What's this 10-10?
Yes.
Okay.
So, Dr. Rose,
Yes, ma'am.
so are the other exercises that you guys did last week also emailed?
They're in the same, they'll be in the same PDF, but yeah, I emailed them out.
Print them out, that's what I'm saying. When I get
Mhm.
to right.
It's a PDF.
Okay, no problem.
Step 1 with double declining is the 100% divided by useful years. Now, in this case, your useful years is not just, well, yeah, it is still just 5. But 100% divided by 5 years gives us what? 20%, and 20% is our single rate. And then step 2, single rate times 2 equals double rate. 20% times 2 equals 40%. Okay. Depreciation for the first year, 2012. It's partial year, first year, right?
Mm-hmm.
So tell me what we need to do. That's what we're about to do now. Tell me, because first year is partial, so you can't just do it like you've done it before.
So since the rate is, at 40%, when you, multiply that by 9, 12, since that's,
You telling me or you asking me?
I'm good.
Good, because I already got a degree, right? So you're supposed to tell me. All right, what's the book value? Beginning book value from the previous problem? 280,000, and like your classmate said, times the 40%, and then times what else? 9/12 gives us what? $84,000, and that 84,000 is gonna be your first year depreciation. No. Yeah, you're right. First year depreciation, and then what do we need to do in order to get to the second year?
Oh, that's the book value.
Which is your,
Which is your, book value for 2013.
that's your depreciation, but you're trying to get your book value for 2013, right?
Right.
So book value, we do 280 minus that 84,000, which gives us what?
196,000.
196, and then we want to take the 196,000 and do what?
Multiply by 40%.
Multiply by your double rate. Which gives us what? 78,000. That was a lot.
It's not a lot when you know how to do it like that.
Right, that's always the key, right? Knowing how to do it. You don't understand it, then I guess it's gonna take you 5 hours. Okay, so last one, I'm gonna let you copy that down, but the last one we have where you can take, and then you'll be able to take a breather, is exercise 10-11. And keep in mind, I just suggest, because the lectures are recorded and because it's posted on the front page for you and because these notes are also emailed to you, if it's something that you don't understand, the best thing to do is put those notes right in front of you and watch the lecture all over again and just go through the problems on your own again. That's the only way you're really gonna learn. Let me know when. Ready? Okay. Exercise 10-11. Apex Fitness Club uses straight line depreciation for a machine costing $23,860 with an estimated 4-year life and a $2,400 salvage value. At the beginning of the third year, Apex determines that the machine has 3 more years of remaining useful life, after which it will have an estimated $2,000 salvage value. Compute 1, the machine's book value at the end of its second year, and 2, the amount of depreciation each for the final 3 years given the revised estimate. So, in this case, this is one of those situations where useful life has been extended, salvage value has been lowered, right? So we're calculating depreciation and then we're turning around and revising it, so to speak. So if we're doing number one wants us to look at the book value at the end of its second year. Straight line depreciation depreciates the same every single year, right? So we know it's cost minus salvage divided by the useful years. What was the original cost? 23,860. What was the salvage? Useful years? What is the normal depreciation? So because we're doing, we need to know what the book value is. Well, we need to know depreciation for 2 years, right? You said it's 5,000. How much? Obviously, we need to add year 2 as well. 5,365. How much does that give us? 10,730. Okay, so that 10,730 needs to be subtracted from what? Book value, end of year is what we're trying to find. We do 23,860 minus this 10,730. What's the new book value?
13,130.
Okay. New book value. Now that we have new book value, the second thing they want us to do is find out the amount of depreciation now that everything has been revised. New book value, we just calculated at 13,130, right? What is the one thing that we just need to account for? Because we don't have to make it complicated. What's the thing that you need to account for along with this new book value? The salvage, which was how much? So if we did book value at 13,130, right? And subtracted the new salvage of 2,000, what's the new depreciable value? 11,130. Since that new depreciable cost, now we got to do what all over again?
Divided by 3 more years.
So now we got to take that 11,130 and we're going to divide it by 3 years, which is going to give us a depreciation of what for the remaining 3 years? 3,710 every single year for the remaining 3 years. Yes?
Yes.
Bless you.
So, where did the 4 years come from?
That was the initial useful life. In the problem on in that first sentence where it says Apex Fitness Club uses straight line depreciation for a machine costing $23,860 with an estimated 4-year life.
Okay.
So it is now 10:03. 20 minutes. Can you come back at 10:24? Yes.